You're probably sleeping on the best investing region in the country right now. It's affordable, it's got cash flow potential, and they're on-market deals that fit my buy box. Today, I'll share with you which region I'm talking about, why I think it makes sense for so many investors, and I'll even drop my list of 5 markets anyone looking for a new place to invest would be crazy not to consider. Hey everyone, welcome to On the Market. I'm Dave Meyer. I started investing in real estate 15 years ago in Denver, and I did that for a while. But I actually wound up moving to Europe with my wife for a couple of years. And when that happened, all of a sudden, the whole country opened up for me in terms of possible investment places. And there's plenty to like in the Southeast, in the Sun Belt. There are tons of good, expensive markets with huge appreciation. But I started quickly realizing that the Midwest, and more specifically the Great Lakes region, fit a lot of what I was looking for as an investor. And I've gone on to invest in that area, and I'm looking to invest more. And in today's episode, I'm going to explain why and make my case for this region as something you should potentially consider as well. And as we're getting into this, I want to mention that I am so interested in this region of the country. Henry Washington and I are actually going there in mid-July to drive around. We're going to go look for markets. We're going to look for deals as part of Bigger Pockets' first ever cash flow roadshow. We're actually considering buying deals if we find some good ones along the way. And we actually have 2 free meetups I want you all to know about. You can join us in Chicago on July 15th or in Indianapolis on July 16th. It's going to be a great networking opportunity, a lot of fun time. So they are free, but you do have to RSVP. So we will put the link in the bio, but also go to biggerpockets.com/roadshow and you can sign up for free for those events. Hope to see you there. For this episode, what we're going to do is we're going to define quickly housing affordability and examine its key components, because that's sort of the basis of my thesis around the Midwest. Then I'm going to present some current data on a variety of affordability metrics for cities in the Great Lakes region, like Milwaukee, Madison, Chicago, and so on. And then I'm going to compare them to more expensive markets that still have great investing potential, but I just want to compare and contrast them. And then I'm going to just talk about how real estate investors can take advantage of what's going on in the Midwest and why I believe the Midwest stands out for value and sustainability, and how investors from really across the country should consider Midwest opportunities. In the housing market, affordability has a pretty specific definition. It's how easy the average American can afford the average price home. And within that, there are sort of 3 things that make up affordability. Of course, there are home prices. Then, of course, there's mortgage rates. And then third is household income. So when you look at all 3 of those things together on a national basis, affordability is really bad. It is actually close to 30 or 40-year lows. Like the last time we saw housing affordability this low was in the early 80s when mortgage rates were like above 10%. Prices have just gone crazy over the last couple of years, and in the last 2 or 3 years, mortgage rates have gone up as well, and that has created a real challenge with affordability. The typical ownership cost right now, so if you add together mortgage, taxes, insurance, all that for home ownership, it eats up about 1/3 of the average person's income. That's pretty high. Traditionally, what experts believe is sort of the upper threshold of affordability is 28%. You know, that matters. That's probably hundreds or thousands of dollars per year that people are now spending on homes that they would normally have spent elsewhere in the economy, they would have saved, or they would have invested. And I think this is going to matter a lot for the housing market going forward. I believe that there are certain markets that have just gotten so expensive that it is difficult, and it's going to continue to be difficult for prices to continue to go up and for rents to keep pace. My belief is that demand is going to start moving towards places where it is relatively more affordable, and that's going to help the housing market stay stable and continue to see consistent appreciation. And businesses tend to follow affordability too. If they can get cheaper real estate, if they can have a less expensive workforce, then they will move to more affordable areas. That creates more jobs, a better economy, and better conditions for real estate investing. The last thing I just want to mention about affordability is these places that are more affordable tend to be more stable. There's less volatility in these kinds of markets when the market swings. And because there's so much uncertainty in the market right now, I am happy with a slow and steady market. I do need to see appreciation. I need those fundamentals, absolutely. But if you can find an affordable market that is growing, man, to me, that is the perfect sweet spot to be in 2025. So that's my rant and thesis about affordability, especially for buy and hold kinds of investments. So let's now just start to look at affordability metrics and how the Midwest compares to other places in the country. So we're going to do this in a couple of different ways. There's different ways to measure affordability. The first and easiest one is just median home price, right? Like how much are you paying for the average home? Milwaukee, for example, which has been one of the hottest housing prices in the nation. It's still up 6% year over year, one of the fastest growing markets in the country right now. So even though it's in the Midwest and people say there's no appreciation there, that has had strong appreciation. The median sale price is just $199,000 as of April. That is less than half the national average. So definitely an affordable market. Let's look at Indianapolis. I talk about Indianapolis a lot because it has really strong fundamentals. One of the hottest markets, I think Zillow named it the #2 hottest market in the country. The entry point, low 200,000s, 220, 230,000 is the median home price in Indianapolis. What about Pittsburgh, which by some measures is the most affordable market, not in the country, in the entire world. When you compare the incomes in Pittsburgh to home prices, some measurements say it is the most affordable market at $237,000 just in median home price. You get to some bigger cities like Chicago, you move up to $345,000, but these are all markets where the median home price is at or less than the national average. So by that measure, Midwest is doing pretty well. We'll just show just the difference here. If you look at Seattle, where I live, the median home price is $851,000, right? So that is 4 times higher than it is in Milwaukee. You could buy 4 houses for every one you can in Seattle. It's 3.5 times higher than it is in Indianapolis. So that's pretty dramatic. In San Diego, the median home price was $1 million in May, right? It's really, really different. So as I talked about, I think affordability is going to help, the housing market continue over time in a lot of these markets in a stable way. I'm not saying San Diego won't grow. It probably will. I'm not saying Seattle won't grow. I actually think it really will. But as an investor, if you're looking to buy value and be able to scale a portfolio, being able to buy 4 properties in Milwaukee that is also growing and has cash flow is a very interesting proposition, to say the least. Let's move on, because we have 2 other metrics of affordability that are super important for cash flow. Because as I said, San Diego, Seattle, probably going to grow, but the cash flow prospects in those cities aren't that great. So let's look at some metrics on how much cash flow you can buy for your money in the Midwest. The first is going to be home price to income ratios. Remember, I mentioned affordability. That matters a lot. It's basically how expensive is a house relative to the average income in that area. And again, even though in Seattle and in San Diego, people have really high salaries. But when you look at it as a ratio, the Midwest, again, really stands out. Many Midwest cities have really low ratios. Like Detroit is 1.9%. In Indianapolis, it's 3.3, basically meaning if you put 100% of your income towards buying a house, it would take you 3.3 years to do that. Milwaukee's 3.8, Pittsburgh's 3.4. So all these are relatively low. That probably doesn't make sense to you without a lot of context. So let me just compare this, for example, to a city like Miami. That's 8.5 years. New York, 10 years. San Diego, 10 years. Los Angeles, 12 years. So again, just measuring affordability. Normal people can afford to buy homes in the Midwest where they can't as much in these really expensive markets. And to me, this just means that it's going to have a healthy housing market in the future. And again, to me, healthy doesn't mean going up 5, 10, 12% every year. It means where normal people with normal jobs can afford to participate in the housing market. That, to me, as an investor, is a market I want to be in. I think it's good just for the general society. I think it is good for demand over the long run. And for me, it makes my investment a little bit more predictable, which I really like. Next, let's turn to rent to price ratios, which we're going to actually use rental yields, which is a little bit different than how we always measure it on the show. Usually on the show, we measure 1 month of rent divided by the purchase price. We're going to measure it by a year of rent divided by the purchase price, but basically the same thing. The higher the rental yield, the higher the potential for cash flow. So when you look at these markets in the Great Lakes region, like Cleveland, the rental yield's 8.4%. Chicago, it's 7.8%. Buffalo, 8%, Detroit, 7%, Pittsburgh, 7%. So all really good, relatively speaking. When you compare it to Boston or Seattle, it's 4.5%, so a lot lower. Los Angeles, 4.6%. It's not exactly half, but it is definitely pretty low. So this means that in these markets that I just mentioned, like Milwaukee and Indianapolis and Chicago and Cleveland, the potential for cash flow is just better. The ratio of how much you pay for a property to how much rent you can collect for that property is higher, generally speaking, than other areas of the country. And when you look at these affordability metrics altogether, when you look at just the entry point, when you look at the income to price ratio, when you look at rental yields, it paints a picture to me of a stable housing market environment. This is, of course, not true for every single market in the Midwest or the Great Lakes region, but just regionally speaking, it does stand out in terms of its ability to generate cash flow and its affordability, which for me as an investor in 2025, that's where I want to spend a lot of my time. Now, I have invested money in higher price cities looking for appreciation, and I do that. I choose to sort of split my investing. I do some for high appreciation, and that's a little bit riskier, but it can really generate some huge rewards. Others, for my retirement, I just want stable, good assets that I'm going to want to hold on to for 10 or 20 years. And to me, the Midwest really offers that second part of my portfolio. And that's why I've been spending a lot of time looking for and executing on deals in that region. Okay, so those are some of the affordability metrics, but let's just recap sort of this Midwest advantage for long-term buy and hold investments. First and foremost is cash flow and holding power. As I've said, I think that the Midwest offers the best cash flow potential, regionally speaking, in the country because they have those higher rent to price or rental yield ratios. And for me, I've talked about this a lot, but buying right now in these kind of uncertain times, I need cash flow. And I'm not crazy about it. I don't need some enormous cash flow if it's a great asset, but I need it minimum to break even, get a 2 or 3% cash on cash return that's factoring in all of the expenses, none of that fake cash flow, real cash flow. I want that early in my investment because that allows me to hold on. My whole strategy around Midwest is buying great assets that are likely to appreciate and holding on to them for a long time while my rent income grows and my cash on cash return grows. But in order to be able to hold on to these, I need that positive cash flow. And so that's why I've personally been targeting with some of my longer term investments, these cash flowing areas of the country in the Midwest. So that's the number one Midwest advantage, I think, right now. The second thing is sort of this steady appreciation versus volatility. And I'm the first to admit the Midwest historically sees slower home price appreciation. It hasn't seen the same things that we've seen in the Southwest or the Sun Belt. And I'm okay with that personally, because you can still buy a lot lower. You can buy for a lot of value. And if you buy in the right markets in the Midwest, they are still appreciating. I'm not saying that I would invest in a market where prices aren't going up. I wouldn't, because that's a number one inflation hedge. It's a great way to get leverage returns. It's just part of investing in real estate is you want appreciation. But what I like about some of the areas in the Midwest is that they appreciate steady. They just 3-4% year after year. They haven't seen these wild swings. Yes, Boise, Austin, Phoenix, they grew like crazy during the pandemic. They've been in corrections for the last several years. And if you bought in 2019 or 2020, you're still doing great. Don't get me wrong. But for me, trying to buy now for my retirement in 10 or 20 years, I just want a market that's going to grow steadily and have cash flow. And that's what is offered in the Midwest. The third thing is this low entry cost, because this allows, first of all, people who are new to investing to get into markets where maybe they couldn't afford where they live, right? If you live on one of the coasts or in the Southeast or in the Sun Belt right now, it's pretty hard to get into the market. And that lower cost of entry in a solid market means a lot. It means that you might be able to get your deal a lot faster, to start that amortization faster, to start getting those tax benefits faster. That is really compelling for a real estate investor. And it's not just for your first deal. That lower entry point means, one, you can scale your portfolio faster. You can buy more units if that is important to you. For me, I focus on quality of units more than buying more units, but it means I could buy more quality units faster because of that lower price point. And it also means more diversification. If I have X amount of dollars to spend, in the Midwest, I could buy a single family home in one region I like. I could buy a duplex in a different neighborhood that I think might appreciate. I might even buy an apartment building for basically what it would cost me to buy a single family home in Seattle or San Diego. And that diversification, again, gives me a lot of optionality, which I, as an investor, really like. So those are just three of the examples: the cash flow potential, the lower volatility, the lower entry point. And then last thing I want to say here is about the stability and tenant demand. Again, not every market, we'll talk about specific markets, but many of them have growing populations with really good renter bases. And to me, that tenant demand is super important. It's going to lower my vacancy, which I care a lot about. I really, as an out-of-state investment, I want low vacancies. I don't want turnover costs. I want people who are going to stay for a long time. And there are great cities for this. If you look at Indianapolis or Columbus or Madison, they all have really low vacancy rates. And to me, that adds that stability to my portfolio that I am looking for in these long-term holds. So those are some of the advantages I personally see in the Midwest. And it's not just me, right? Like if you look at the hottest list for home prices in the country, Zillow's top, the number one, Buffalo, New York in the Great Lakes region. Number two, Indianapolis in the Great Lakes region. You know, usually on these lists, you see things like Boise or Austin or, Dallas or something like this. These markets are hot because there's relatively low supply, but there is sustained demand. And that is a great thing as a real estate investor. Now, for people who live in the area, that's pretty obvious, right? Like if you happen to live in the Great Lakes region, I think investing in your own market, in your own backyard, makes a lot of sense. There are probably several good markets within driving distance if you do live in that region. So I would focus on figuring out which markets have the strongest fundamentals around you and just investing in your own backyard. But I also think investing out of state or long distance into some of these markets can make sense for certain investors. Many investors who live in high-cost cities like Seattle or San Diego or Boston, New York, whatever, I get this question all the time. People are struggling. They're trying to figure out how to make a first investment. And the deals are thin. You're looking at a house hack that may not make you a ton of money, or you're banking on appreciation and you're not getting any cash flow. Those things can be right for some people, but I think for a lot of folks, especially who are looking for this long-term approach to real estate investing, considering investing out of state in some of these markets can make a lot of sense. You're going to be able to buy a lot more units because it's much more affordable. You'll be able to get that cash flow that provides stability, and there are all the other benefits that I actually talked about. Now, if you're going to do this, it's super important to hone in on a good market, because there are absolutely markets within the Great Lakes region that probably aren't great for real estate investing. Lots of places in the Midwest that are seeing population decline, just as an example, right? And you still can invest in places with population decline, but that's something you want to know. And for me, as an out-of-state investor, I'd rather just, invest in a growing city. Just off the top of my head, there's cities like Des Moines, Iowa. That's growing a lot. Indianapolis is growing. Madison, Wisconsin is growing. Columbus is growing. These are the kinds of markets that have really strong fundamentals in population growth because they have really strong economies. So just for example, I just pulled a couple of numbers here, but you look at Milwaukee, there's a reason that we're going there on the Cash Flow Roadshow. great cash flow potential. It also has a super affordable price point at $200,000 in median home price. It's growing at one of the fastest rates, so it's seeing good appreciation right now. And its population is growing. And so there's a lot of fundamentals to like about Milwaukee. You should still dig into the economy, make sure there are good jobs moving to the area, make sure that there aren't any red flags like rising vacancy. But on paper, Milwaukee has a lot of what you might look for in real estate investing. Look at Chicago. I think a lot of people sleep on Chicago. It is a massive metro area. There are pockets that I probably wouldn't want to invest in because they don't have great appreciation or they don't have great cash flow. But there are absolutely pockets in the third largest city in the country where you can buy below the median home price. To me, that is a very compelling investment thesis. And I talk to a lot of people in Chicago who are investing there very successfully. Or you look at Indianapolis. This has very strong population growth, over 1% per year. That's higher than the national average. It has great job growth. It has super low unemployment. People are moving there. People like living there. So there's a lot to like in a city like Indianapolis too. Now I'm just picking these three markets because they're the ones we chose for the Cash Flow Roadshow, but we didn't pick them because they're the three best, markets in the Great Lakes region. We picked them because they're all great and they're within driving distance of each other. But there are lots of other good markets in Western New York, in Chicago, in Indiana, in Michigan, in Wisconsin. They're all over the place. So you should just do your research and figure out which ones are most aligned with your strategy. So that is true whether you are one of those folks I was describing earlier and you are just trying to get into your first investment and you're looking for a way to afford a first investment. That can make a lot of sense. The other type of investor who should consider this, and again, the ones I mentioned are people who live in the Great Lakes region and then people who are looking to afford their first deal. The other avenue is for people who want diversification within their real estate portfolio. That's why I do it. I started investing in Denver, which was more affordable when I started, but it's become a more expensive market. I still have a portfolio there. I have started to make some investments here in Seattle, which is a very expensive market. And I want to diversify. I also want to be in more predictable markets. To me, this provides the right balance for my long-term portfolio. Some more expensive, more appreciation-focused markets that allow me to take some big swings while I have my more stable, predictable portfolio in the Midwest. And I think this resonates with a lot of people when I talk to them about it, is trying to diversify just regionally and types of markets. And so even if you invest in a more expensive market, you could still invest out of state or long distance in some of these regional areas if you buy into my thesis or for other reasons think that the Great Lakes region or the Midwest more broadly could be a good move for you. Now, of course, if you're doing that, you do need to build a team. So it's really important to find a great agent and to find a professional property manager. But you absolutely can do this. I have done it relatively easily. I have a great property manager in the Midwest that I use now, and I trust to not only manage my properties, but help me look for more deals. And if you are diligent and follow the steps that we always share on Bigger Pockets about how to invest long distance, you absolutely too can find the right team to help you do this out of state. I will tell you from personal experience, I have invested in my own backyard. I have invested out of state, long distance. It really isn't that much harder. It does mean you're going to pay a property manager, but when you consider the affordability and benefits of cash flow that are in this region, it usually more than offsets the cash flow differential that you would get in investing in a super expensive market. So for me, that diversification piece is key and why I personally have started putting some of my money into these regions. So before we get out of here, I do want to share with you 5 markets that I particularly like in the Midwest. This is no means comprehensive. There are many more that I like, but these are just 5 that I was looking at and thinking about yesterday when I was writing this outline. So I'm going to share them with you. Again, 3 of them are on purpose, the ones that we picked for the Cash Flow Roadshow because I've been researching them a lot and they are top of mind. So number 1 is Milwaukee. It's got a lot going for it. It has a diversified economy. It does have manufacturing. It has healthcare. There are more tech startups in the area. What I like about it is, again, the affordability, but it also has a large renter population, which means that I can get in early, and I believe that I'm going to have long-term tenant demand for my properties, which is going to lower my vacancy rate and provide stable upward pressure on rents. I don't expect it to go crazy. I'm not trying to price gouge. I'm just saying that, in a market with strong demand, rents are probably going to be at least keeping up with inflation, which is super important to me. Now, normally, Milwaukee has been a lower mid appreciation market, but it's been really, really booming the last couple of years. And again, I believe in large part that is due to the affordability. And so I do think it will slow down. I don't think Milwaukee is going to remain the hottest market in the country going forward, but it is encouraging to see that these affordable markets in the Midwest are seeing really good appreciation compared to national averages. That, as an investor, is obviously something you're really going to like. My second market, also in Wisconsin, is Madison. This is one I'm going to visit in a couple of weeks. I'm really interested in it. Madison's a little different. It's kind of a different play because Madison's affordability has diminished, but to me, it's kind of an interesting, maybe hybrid market where it's not fully affordable, but it's still so much cheaper than like tech hubs like San Jose or Seattle, where there's a blooming sort of tech scene in Madison. It is more expensive. Cash flow is a little bit lower, but I do like the stability that comes from the state government being there, the University of Wisconsin being there. I think it has really stable demand. It has low vacancy. It's one that I like personally. Third is Chicago. And again, I understand some people shy away from Chicago due to landlord regulations or taxes, but it is just so affordable. Again, the third largest city in the US, there are so many people living there. There are so many pockets, so many neighborhoods to invest in. And with the average home value being in the 300,000s and rents being relatively high, Chicago has good cash flow markets. And if you buy in the right neighborhood, you definitely could get cash flow and appreciation at the same time in an enormous city where you're not, betting on some city turning around. Obviously, Chicago has a huge, massive economy, and that is very likely to continue. And so I think Chicago is overlooked by a lot of people. Fourth is Indianapolis. You guys know I think this is a standout market just because it has such great job and population growth and still being so affordable. I haven't been there in years. I'm super excited to check it out on the roadshow. Again, we're doing a meetup there on July 16th. If you're in the area, it's free. But there's just a lot of things to like. It's affordable. They have good laws. They have a diversified economy, favorable tax treatment. All this stuff is pretty good. Indianapolis, really strong market. Last, I have said again, Pittsburgh. I know not everyone considers this the Midwest, but it is in the Great Lakes region. And again, one of the most affordable markets in the world. And it has tons of tech companies. It is one of the sort of robotics hubs of the country. Google and Uber have offices there. There's great universities there. The rent to price ratio is excellent. So I think Pittsburgh, again, it hasn't had historically great appreciation. That's something to call out. But I think there's a lot to like about what's going on in Pittsburgh. Something, if you're thinking about the Midwest, I would look into a little bit further. So those are the 5 markets I like. But again, there are a lot more out there. In conclusion, as we wrap up this episode, I just want to remind everyone, my basic theory here is that affordability is going to be good for me and potentially for other investors for long-term buy and hold. For people who want to build their portfolio and get in at affordable price points where there is the potential for cash flow. So you have a high degree of confidence that you can hold on to these properties for a long time. The Midwest offers a lot of things to like. It is probably not going to grow as fast as it has the last couple of years. That is probably not going to continue. You probably won't see many Midwest or Great Lakes markets on the fastest appreciation markets in a couple of years from now. But I do really believe that they're going to offer stable growth, low volatility growth, which for me is something I like. I know if James were here, he would not accept this approach to real estate investing, but this is how I handle a good portion of my portfolio. I spend the rest of my portfolio investing in higher risk, higher appreciation markets like Seattle or investing in syndications. I do all of that. I like to build out a portfolio that is balanced for risk and balanced regionally. But I am putting some of my money and some of my portfolio into the Midwest for a lot of the reasons I mentioned above. And I think it's a really good area for a lot of our listeners here to consider as well. Thank you all so much for listening to this episode of On the Market. If you have any questions, please don't hesitate to reach out to me on biggerpockets.com or on Instagram. And again, if you're in the Chicago or the Indianapolis region on July 15th and July 16th, make sure to join us on the Cash Flow Roadshow. It's going to be a lot of fun. Hope to see you there. Thanks again for listening. We'll see you next time.